So the next time you pull out your smartphone and you open your brokerage app and you tap that glowing green buy button, I want you to know this. Before you even lift your thumb off the glass, your order will likely travel at the speed of light to a server in New Jersey.
Oh, yeah. Completely.
Right. Gets sliced into like 50 different microscopic pieces, scanned by algorithms, and potentially even sold to a private firm.
I mean, the illusion of the smartphone era is just this frictionless simplicity. You hand over the cash, they hand over the digital certificate, and it feels completely instantaneous.
Yeah, it feels like magic.
It does. But the reality, if you could actually rip the screen off and look at the infrastructure, is it's basically a violent, high-speed digital relay race.
It really is. Welcome to the Franks Report. I'm Philip.
And I'm Jessica.
And before we unpack this massive digital labyrinth, just a quick reminder to hit that follow button wherever you're listening so you never miss a deep dive.
Yes, definitely do that.
So our mission today is to completely shatter the illusion of that simple buy button. We're going to demystify the mechanical realities of the global marketplace for you.
Right, because by the end of this deep dive, you are going to understand exactly where your money goes in those hidden, those fractions of a millisecond.
Exactly. So, I guess the journey of a financial order really has to start with geography, right? And architecture.
Yeah, absolutely. Long before an order gets routed or sliced up or filled, it needs a destination. The physical and digital venues where buyers and sellers actually meet, I mean, they dictate the rules of the entire game.
So we have to look at the primary exchanges first. And the contrast there is just, it's stark.
It really is. I mean, if you ask the average person on the street to picture the stock market, they usually visualize the classic New York Stock Exchange.
Right. Crowded physical floor.
Exactly. People in brightly colored jackets screaming at each other, waving those little order slips around.
Yeah, which is great for movies, but that imagery persists because historically, the NYSE operated on what was called a specialist system.
Right.
The exchange literally designated a specific human being to act as the market maker for a specific stock.
Which is wild to think about now. Their entire job was just to stand at a wooden post on that floor and maintain an orderly market.
Right. So if a massive wave of sell orders came in for, say, a big industrial company, that human specialist was legally obligated to step in and buy.
Yeah, they had to absorb the shock to keep the price from just going into a total free fall.
But the architecture of the market completely fractured when newer exchanges realized that human beings are just, well, we're too slow.
Way too slow. I mean, the NASDAQ didn't even bother with a physical floor or a single human specialist.
No, they didn't.
They built a purely electronic dealer network right from day one. So you had multiple geographically dispersed market makers all competing for orders over these early computer networks.
Which ended up forcing spreads tighter just through purely digital competition.
Exactly. And then, you look at the derivative space, like the Chicago Mercantile Exchange or the CME.
Right.
Their structural model is completely different from the fragmented stock market. I mean, in equities, a single company's stock might trade on 30 different venues simultaneously.
Yeah, it's everywhere at once.
But the CME is this highly centralized fortress. A specific futures contract, like the S&P 500 E-mini, usually only trades on the CME.
Because the CME created it, right?
Exactly. If you want to trade that contract, you have to play in their specific sandbox. You have to interact with their specific liquidity pool.
Okay, so regardless of whether it's the fragmented stock market or the centralized futures market, every single one of these venues relies on the same beating heart to function.
The matching engine and the central order book.
Exactly. And the order book is, it's the ultimate truth of any market.
It really is. It's this massive, continuously updating digital ledger that just lists every single resting buy order and sell order, organized strictly by price.
And the matching engine is just the software algorithm that reads that ledger and pairs the buyers and sellers together.
But that pairing process, it can't just be arbitrary. If 1 million people are submitting orders every second, the engine needs an unbreakable hierarchy.
Right. It has to decide who gets their trade filled and who gets left out in the cold.
Exactly. And that hierarchy is an algorithm called price-time priority.
Right. Price-time priority.
And the mechanics of that rule are honestly what prevent the global financial system from collapsing into pure chaos.
It's foundational.
It is. The absolute best price always wins. That is the very first filter.
I always visualize this as a hybrid. between like a high-end art auction and a deli counter ticket system.
Oh, that's a really good way to think about it.
Right. So the price aspect is the auction. If someone is bidding $10 for a share and you walk in bidding $11, you just jump to the very front of the line.
Your superior price literally buys you priority.
Exactly. But the complication comes in when the auction results in a massive tie.
Right, because if 10 different high-frequency trading algorithms all shout out a bid for exactly $11 at the exact same microsecond, what does the engine do?
That's when it relies on the time component, the deli counter.
Yep, you pull your ticket. Whoever's digital data packet arrived at the exchange's server first, even if they beat the next guy by a single nanosecond, gets their order filled first.
And that mechanical certainty is basically the bedrock of market confidence. If you improve the price, you get filled. If you match the price, you just have to be faster.
Yeah, exactly. But, as we move through the 1990s, institutional traders realized that routing orders through traditional brokers to reach those primary exchanges was a huge bottleneck.
Right, they needed to bypass the traditional infrastructure entirely.
They did. And that demand for raw speed burst the electronic communication networks, or ECNs.
So venues like ARCA, which was eventually absorbed by the NYSE.
Right, and Baytest, which is now run by SIBO, these were essentially alternative hyper-fast matching engines that operated completely outside the legacy primary exchanges.
ECNs really revolutionized the architecture because they allowed major brokerages and institutional funds to trade directly with one another, like instantaneously.
But building a super fast digital network is completely useless if nobody actually shows up to trade on it.
Very true.
So ECNs had to actively lure liquidity away from the New York Stock Exchange and the NASDAQ.
And the mechanism they invented to steal that market share is, well, it's fascinating. It's called a maker-taker fee model.
Yeah, that completely altered how algorithms approach trading.
Really did.
I mean, the maker-taker model is basically pure behavioral economics applied to market microstructure. An exchange only has value if it has depth.
Meaning a massive pile of resting orders just sitting on the order book waiting to be executed.
Exactly. So if you place a limit order saying, you will buy stock at $50, and you let that order sit there passively, you are providing liquidity. You're a maker.
Okay, so you're making the market.
Right. The ECN desperately needs your resting order to attract other traders, so they will actually pay you a tiny, microscopic rebate for just letting your orders sit on their book.
See, but what if I don't want to wait? Like, what if the market is crashing or some massive news story just broke and I submit a market order that says, buy this right now? I don't care what the price is.
Well, in that scenario, your order aggressively sweeps the book, consuming those resting limit orders.
Right.
You're taking liquidity away from the ECN. So you are a taker. And for the luxury of that instant execution, the ECN charges you a fee.
Which makes sense. And for a single retail trader, paying a fraction of a cent is basically invisible.
Oh, yeah, you'd never notice it.
But for an institutional algorithm trading tens of millions of shares a day, harvesting those maker rebates and avoiding the taker fees, I mean, that becomes a massive standalone profit strategy.
Oh, absolutely. It's a huge revenue stream.
I do have to challenge the premise of this entire fragmented system, though.
Okay, let's hear it.
Because if these ECNs successfully fractured the market, it means the true price of a stock doesn't really exist in one place anymore, right?
Technically, yes.
The liquidity for one company is now scattered across a dozen different digital islands at any given microsecond. We have ARCA, BATS, NASDAQ. The NYSE isn't that kind of dangerous.
I can see why you'd think that.
I mean, how does a heavily fragmented market actually benefit the average investor who's just trying to find the actual price of an asset?
Yeah, the immediate instinct is to view fragmentation as chaotic. But from a systems engineering perspective, it actually provides incredible resilience.
Resilience how?
Well, consider a centralized model. If all global trading for a massive tech company occurs on one single physical server rack and a localized power grid fails,
Oh, I see.
or a single fiber cable is severed, the global valuation of that company literally flatlines.
Right, it's a single point of failure.
Exactly. With fragmentation, the market acts like a distributed network. If one ECN goes completely offline, the liquidity just instantly, organically routes to the surviving venues.
The market simply routes around the damage.
It does.
But that creates a massive logistical headache for the listener, right?
Yeah.
If you're sitting on your couch, tapping your app, and liquidity is scattered across 15 different surviving venues, you can't manually check all of them to find the best price.
No, you definitely can't. But you don't have to, because the moment you press buy, Your order is handed to the technological brain of your broker.
The smart order router, the SR.
The SR.
See, the SR has always fascinated me because it operates in this opaque nanosecond window. What exactly is this algorithm executing when it grabs my order?
Well, it basically acts as a hyper-intelligent digital traffic cop. It simultaneously queries the order books of the NYSE, the NASDAQ, ARCA, BATS, and every other protected venue.
All at once.
All at once. It assesses the available price on each exchange, the depth of shares sitting at that price, and the historical latency, meaning how long it will take a message to actually reach that specific venue.
And its primary mandate is strictly regulated, right? Under U.S. law, specifically Regulation NMS, the National Market System brokers are legally obligated to execute customer trades at the National Best Bid and Offer, or the NBBO.
Exactly. The NBBO forces the SOR to consolidate that fragmented market into one unified best price.
Okay, so give me an example of how that looks in practice.
Okay, so if the legacy New York Stock Exchange has sellers offering a stock at $10.05, but a newer ECN has sellers offering it at $10.04, your broker's SRR is legally barred from routing to the NYSE.
Because it's a worse price.
Right. It must route to the ECN to capture that 1 cent price improvement for you.
And the SOR will even butcher in order to achieve this, won't it?
Oh, absolutely. If you submit a massive order for, say, 10,000 shares, and the SOR sees that the best price is heavily fragmented, it won't just send the whole order to one exchange.
It slices it up.
Yep, it will slice your single order into 50 tiny pieces and shotgun them across 5 different venues simultaneously, just to sweep the very top layer of liquidity off the NBBO.
It's an incredibly efficient compliance tool, but it operates under a deeply embedded conflict of interest.
Ah, yeah, here we go.
Because this is exactly where the maker-taker model collides with the smart order router. The SOR has to obey the regulation of the NBBO first. It must get the best price.
Right.
But what happens when there is a tie? What if venue A has the stock for $10.04 and charges a fee, while venue B has the stock for $10.04 but pays the broker a rebate?
Well, the moment the price ties, the broker's profit motive just takes over.
Exactly. The algorithm instantly optimizes for the brokerage's bottom line. The SOR routes the trade to the venue that maximizes the rebate or, minimizes the fee for the broker.
And as a retail trader, you are entirely blind to this decision matrix.
Completely blind. The invisible hand guiding your execution isn't always finding the deepest liquidity. It's often finding the most profitable routing path for the firm handling your order, provided they don't violate the NBBO.
And that invisible split-second optimization is exactly why your final fill price might occasionally look a fraction off from the quote you thought you saw flashing on your screen.
Yeah, but this entire process, the ECNs, the primary exchanges, the smart order routers, we're still only talking about the eliminated public market here.
Oh yeah, that's just the stuff we can see.
A massive percentage of global trading never even hits a public order book.
No, it doesn't. To understand the full architecture, we have to explore the hidden layer.
Dark pools and internalization.
Exactly.
Now, dark pools inherently sound nefarious, right? It sounds like a shadowy back room where the rules don't apply. But the mechanical reality is actually a lot more pragmatic.
It really is. A dark pool is essentially just a private matching engine. They're typically operated by massive global banks or independent broker-dealers.
And the fundamental difference between a dark pool and, say, the NASDAQ is just transparency.
Exactly. The NASDAQ broadcasts its order book to the entire world. A dark pool operates in complete silence. Nobody sees the buyer-sell interest until the trade has already been executed and reported to the tape.
And the necessity for this goes right back to the concept of market impact.
Right.
Because if a massive mutual fund needs to buy 5 million shares of an airline company, they can't just dump that order onto the public NASDAQ order book.
Oh, if they tried, it would be financial suicide.
Total suicide. High-frequency algorithms would instantly spot that massive wave of buy interest sitting on the book.
And those algorithms would race ahead, buy up all the available cheap shares, and just raise their selling prices.
Yeah. The mutual fund's own massive size would push the price of the stock higher and higher before they could even finish their purchase.
So the dark pool allows the mutual fund to submit their massive order into a hidden venue.
They just wait in the dark.
They do. They wait in the dark, hoping a massive seller eventually shows up to take the other side, entirely avoiding that public feeding frenzy. It protects institutional giants from basically cannibalizing their own trades.
Makes total sense.
Okay.
But for the listener tuning into this deep dive, dark pools are probably a lot less relevant than the other major off-exchange mechanism.
Which is internalization.
Right. Internalization dictates the reality of the modern retail brokerage account. This is the scenario where your broker looks at your order and decides to simply step in and take the other side of the trade themselves.
Right. If you want to buy 100 shares of a tech company and your broker has 100 shares sitting in their firm's own inventory account, they don't route your order to New Jersey.
No.
They just sell you their own stock.
You know, it's like a car dealer, right? If you walk in wanting a specific sedan and they already have it sitting in their own back lot, they're just going to pull it around for you.
Right.
They aren't going to go to a public auto auction to find it because it's faster and cheaper for them to just handle it internally.
That's a perfect analogy. And from a mechanical standpoint, this removes an incredible amount of friction. The broker avoids paying routing fees, they avoid exchange taker fees, and the execution is essentially instantaneous for you, the client.
As long as the broker provides a price equal to or better than the national best bid and offer, they are fully permitted to act as the counterparty to their own client's trade.
Which brings us to the most debated mechanism in modern finance, payment for order flow, or PFOF.
PFOF. When a zero-commission broker doesn't have the inventory to internalize your trade, they don't send it to the public exchange either.
No, they bundle millions of retail orders together and sell that massive pipeline of flow to wholesale market makers.
These are massive quantitative firms like Citadel Securities or Virtu Financial.
Exactly. So the elimination of the $10 trading commission didn't actually make trading free.
Yeah.
The cost simply shape-shifted.
Right.
The broker hands your order to a wholesaler, the wholesaler executes the trade internally, and in exchange, the wholesaler pays the broker a fee for providing that order flow.
But let's pull the thread on this. Citadel and Virtu aren't charities. They're paying millions of dollars to buy this order flow. Why?
Well,
Because retail order flow is inherently less dangerous to them than institutional order flow.
yes. The terminology used in the industry is toxic versus non-toxic flow.
Okay, break that down for us.
So an algorithm at a major hedge fund operates with toxic flow. They usually have incredibly sharp predictive information. If a hedge fund is aggressively buying, the wholesaler does not want to take the other side of that trade because the hedge fund is probably right and the stock is about to surge.
But retail flow, millions of regular people buying and selling based on news, podcasts, or just long-term investing is considered non-toxic.
It's essentially random noise to the market maker.
Exactly the point. Because retail flow is uncoordinated, wholesalers can safely internalize it. They make their profit by capturing the spread.
Right. They buy a share from one retail client for $10 and milliseconds later sell it to another retail client for $10.01.
And capturing that 1 cent spread across billions of shares a day generates immense, highly predictable profit, which is exactly why they're willing to pay brokers for the privilege of accessing that flow.
So the commission fee didn't disappear, it was just baked into the microscopic spread of the asset itself.
Yep. But whether your trade is internalized by a wholesaler, matched in a dark pool, or executed on the public NYSE, a digital match is really nothing more than an agreement.
It's just a handshake.
It is. It doesn't mean the money has moved, and it doesn't mean you legally own the asset.
Not at all. The match is just the beginning. The actual transfer of capital and ownership requires entirely different infrastructure, shifting us from the front-end execution venues to the back-office plumbing.
Clearing and settlement.
Exactly. In the U.S. equities market, the Depository Trust and Clearing Corporation, the DTCC, and its subsidiary, the NSCC, handle this mammoth task.
And in the futures market, it's the CME clearinghouse.
Right. Their primary function is to step into the middle of that digital handshake and just eradicate counterparty risk.
Because when you execute a trade on a fragmented market, you really have no idea who is on the other side.
None. You might have bought shares from a highly leveraged hedge fund. What happens if 10 minutes after your trade is matched, that hedge fund's positions collapse and they go completely bankrupt?
Under normal circumstances, you wouldn't get your stock because the seller no longer has the funds to settle the trade.
And that kind of localized failure could trigger a cascading contagion across the entire financial system.
Right, which would be disastrous.
So to prevent that contagion, the clearinghouse legally novates the trade.
Novates.
Yeah, they sever the direct link between you and the bankrupt seller. The clearinghouse legally becomes the buyer to every single seller and the seller to every single buyer.
So they guarantee the completion of the trade, regardless of what happens to the original counterparty.
Exactly.
But taking on the combined risk of trillions of dollars in daily trading volume requires an impenetrable financial safety net.
It does, which is why the clearinghouse forces every participating broker to maintain massive dynamic deposits of collateral.
Right.
The clearinghouse constantly monitors the volatility of the market and the specific positions held by each broker. If a broker's clients are suddenly buying massive amounts of highly volatile stock,
Like during a short squeeze or something.
exactly, the clearinghouse will demand an immediate massive increase in collateral from that broker to cover the elevated risk of a settlement failure. And if the broker can't post the collateral, the clearinghouse can force them to restrict trading.
Wow. And that collateral requirement really protects the settlement process. And settlement meaning the actual final legal transfer of the digital certificate to your account and the physical cash to the seller's account. That doesn't happen instantaneously.
No, it doesn't. The stock market currently operates on a T+1 settlement cycle, trade date plus 1 business day.
And that delay between execution and settlement is a critical gap. It's kind of like swiping a credit card at a restaurant. you
Well,
know?
that's a good comparison.
The terminal instantly approves the charge. Your banking app immediately deducts the money from your available balance. You walk out of the restaurant, assuming the transaction is complete.
It's not.
No, the actual cryptographic movement of cash from your bank's reserve account to the restaurant's merchant account takes days to finalize.
And the stock market functions on the exact same illusion. Your brokerage app updates your portfolio balance the exact second the matching engine executes your trade. You can even turn around and sell the stock 5 seconds later.
Right.
But the heavy lifting, the netting of trillions of dollars in obligations between the DTCC, the brokers, and the central banks, that doesn't legally finalize until the next business day.
Incredible. So all of this complex routing, matching, internalizing, and clearing it all relies on an unfathomable volume of data moving continuously.
Which brings us to the final, unavoidable physical reality of modern trading.
Geography and the laws of physics.
Yes, because digital speed is not infinite.
No, it's not. Data traveling through fiber optic cables cannot exceed the speed of light. Therefore, the physical distance between the server sending the order and the server receiving the order actually dictates everything.
It really does. You know, we often visualize the financial universe revolving around Wall Street and lower Manhattan.
Sure, yeah.
But the true physical center of global finance is actually in New Jersey.
Towns like Mahwah, Carteret, and Secaucus. They house the massive windowless data centers where the primary exchange matching engines physically reside.
And think about the math here. If the NASDAQ Q matching engine is located in Carteret, New Jersey, and a trading algorithm is running on a server in Chicago, that data has to physically travel hundreds of miles.
And in the realm of high-frequency trading, that journey takes a lifetime.
A literal lifetime. A competitor located closer to New Jersey will receive the market data sooner, calculate a response, and send their order back to the exchange before the Chicago data packet has even completed its first lap.
So to eliminate that geographical penalty, professional quantitative firms utilize a strategy called co-location.
Right. They pay the exchanges exorbitant fees to physically install their own proprietary servers inside the exact same data center as the exchange's matching engine.
The optimization here really borders on the absurd. I mean, they aren't just paying to be in the same building.
No, they demand that the physical fiber optic cables connecting their server to the matching engine are cut to the exact same millimeter length as their competitors' cables.
That's insane.
It is. They want to guarantee that their latency, the time it takes for data to travel between the two machines, is reduced to a fraction of a single microsecond.
By comparison, when you submit an order from your smartphone over like a cellular network or a home Wi-Fi connection, your data travels through commercial internet service providers, it hits your broker's servers, passes through the smart order router, and finally navigates all the way to New Jersey.
Which takes forever in computer time.
Right, your latency might be 50 to 100 milliseconds. If institutional firms are operating in microseconds, a retail trader is operating 100,000 times slower.
Yeah.
We are essentially walking into a modern ballistic gunfight armed with a butter knife.
That's exactly what it is.
Yeah.
And the latency gap feels insurmountable, but for the vast majority of retail strategies, it's statistically irrelevant.
Right.
If you're just buying a broad market index fund to hold for 20 years, a 100 millisecond delay on your entry price isn't going to alter your compounding returns.
Sure.
However, understanding this massive speed disparity highlights exactly why retail traders must protect themselves when utilizing order types, especially during high volatility.
Because if you submit a standard market order during a chaotic news event demanding instant execution regardless of price, your order spends 100 milliseconds traversing the country.
And by the time it finally hits the matching engine in New Jersey, the high-frequency algorithms have already reacted to the news, pulled their liquidity, and spiked the price.
Right. Your market order simply buys at whatever the new, significantly worse price happens to be.
And this is the precise reason professional education emphasizes the use of limit orders.
A limit order hard codes your boundaries. By telling the exchange, I will only buy this asset at $50 and not a fraction of a penny more, you completely neutralize the institutional co-location advantage.
Exactly. Your execution might be delayed by your home Wi-Fi, but your price is mathematically protected against the high-speed algorithms sweeping the order book.
Okay, so what does this vast, complex architecture actually mean for you, the listener? I think the primary takeaway is a complete paradigm shift in how you view your interaction with the market.
Definitely. You are no longer just an isolated user tapping a frictionless app.
Every single time you press that green button, you are initiating a highly orchestrated chain reaction. Your intent is parsed by risk servers, evaluated by the smart order router, weaponized into tiny fragments,
Diverted away from dark pools.
pushed through the maker-taker matrix of the ECNs, guaranteed by the massive collateral of the clearinghouses, and finally delivered at the speed of light into a windowless server farm in New Jersey.
The system is just a marvel of human engineering, designed to balance hyper-efficiency with systemic stability. It is not without its conflicts of interest, but understanding the mechanics of how it functions is really the only way to navigate it intelligently.
Absolutely. Now, before we wrap up, I want to leave you with a final provocative thought regarding the future of this infrastructure.
Okay.
We established that co-location exists because data cannot travel faster than the laws of physics allow. Financial firms have spent billions drilling through mountains to lay straighter fiber optic cables and erecting microwave towers to shave nanoseconds off their transmission times. But if the modern market is currently bottlenecked by the literal speed of light, what happens when we physically cannot engineer a faster route? When the hardware hits the ultimate boundary of physics, where does the next edge in market mechanics actually come from? Does the battle shift entirely from speed to, say, predictive artificial intelligence?
The smartest quantitative minds and billions of dollars in research and development are currently focused on solving that exact problem.
It's wild. Keep the reality of this hidden architecture in mind the next time you tap that smooth glass screen and wait for the digital magic to happen.
For sure.
And if you want to explore the bleeding edge of modern market strategies and understand how to leverage these mechanics yourself, you need to visit www.franksreport.com and explicitly check out the book, The Funded Micro: Modern Future Strategies for the Prop Firm Era.
It is an indispensable resource for understanding the realities of modern execution and strategy.
And finally, please remember to follow The Franks Report wherever you choose to listen to your podcasts. Thanks for joining us, and we'll see you on the next deep dive.